Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We've been finding, buying and creating income from investment properties for over 20 years, and we talk every week about the reality of running property businesses. We're going to be talking mortgages today, and if you find that information interesting, please do leave us a rating and review, and we will have a quick fire sort of current guide to the market on interest rates towards the end of this episode, so please do listen through for that. But we are getting started with a chat with our guest, Simon Glastonbury, who's a mortgage broker of many years and much experience. And the first thing I'm going to say is that the next Bank of England base rate announcement is coming up on the 2nd of November. And I thought that the general world knew what they were expecting out of this. But Simon, you have a different opinion. So what's going to happen on the 2nd of November?
Well, there's the question, Simon. Hello, guys. A difficult one. It's interesting. We were talking off camera about what the Bank of England was expected to do, and your initial impression was that, from what you're hearing, it's just going to be staying exactly the same. We are hearing. This is obviously my opinion and what I'm hearing within the financial press. But as looking at the inflation figures on the last report, it's then being indicated that we are going to get a Bank of England base rate increase at the next meeting. Is that going to happen? We really don't know, do we? We're guessing, and we can only look and hear in the outside world and in the professional press at the moment. It's certainly looking that way. The one thing I would add to that, though, is that the banks have priced. Many people talk to me about it and say, "Well," and it sort of puts fear into them, because we've had so many base rate increases over the sort of last year or so, and it's put people in really, really difficult positions, be it residential homeowners or landlords. Everybody is either feeling the pinch now, or they're about to feel the pinch. They're very aware that when they change rates and mortgages, they're going to be hit severely in the most part.
So just a quick one, Simon.
What I would say,
what are we thinking? Another 0.25% if it happens? Obviously, we don't. If you did know and you could tell us, I'd have a bet on it. I'd go long or go short. I'd have a bit of a gamble, but we don't know. But if it did, were we thinking another 0.25%?
Yeah, good point. Sorry, Stuart. Yes, absolutely. I don't think it will be any more than 0.25%. I think if it does, and it's still a big if. We still have another inflation report coming up. So if that does change, if they feel it's necessary, I think a maximum of 0.25%. So I don't think it'll be any more than that. My feeling again, this is only personal, is that will be it. If there is a bit increase, that will be it for a period of time. Obviously, these things can go up, can go down in the future. It will change, but as for the immediate future, I think that's where it will be.
And what do you think that'll do to the mortgage market? Is that going to push everybody's rates up straight away, or is this already baked in?
No, it's already pretty much priced into the market. And when I'm talking about priced into the market, the banks have already looked at this over a 2-year. I mean, for the as the saying goes, as the man on the street is looking at a 2-year, a 3-year, or pretty much everybody looks at a 2-year or a 5-year fixed rate, because they're the most common and they're the most readily available. But there are 3 years and 7 years and 10 years out there. And assess this and what the market is going to be over the next 2, 3, 5, 7 years. And they've priced their fixed rates accordingly. So it's very, very unlikely that you will see much movement in fixed rates, even if it does go up 0.25%. So it's not 0.5%. If it goes up 0.25%, it's very unlikely. What we have been seeing, a steady, slow but steady fall in fixed rates over the last couple of months. I'll put mine. I haven't got the exact figures, but the exact dates, but they are falling slightly. So for the first time, really, we're seeing residential rates dip below the 5% mark. So yes, I mean, they are built in. Don't expect massive drops, but the fear, I think, from the public is then, as soon as a Bank of England base rate goes up, my fixed rate, the fixed rate's going up, let's jump on. That's not necessarily the case, and it wouldn't be something I would expect to see in the immediate future.
Yeah, something we've talked about on the podcast before, and for anyone listening or watching now, go back to previous episodes with Simon where we talk about that, because on some occasions, even on the day of a price rate increase, my mortgage went down slightly just because there was more stability in the market than there was, say, this time last year. And I suppose the only other comment I've got on this is, for people thinking about mortgages, when I'm thinking about it and I'm thinking about my own portfolio and what's going on, the only additional thing I start thinking about now, other than the interest rate rises, is the fact that we've potentially got a general election coming, Q1, Q2 at the start of next year. So we just don't know what's going to happen. So as we get towards the end of our fixed terms, my view, and this, again, my personal view, is I like the stability of knowing what my payments are going to be for a couple of years. So those things alone mean that I think we want to get as much information as we can, as quickly as we can, to make those decisions a bit earlier.
I'd agree. I think it's a very good point about the general election coming up. The government are not going to want to have anything, a volatile market, a volatile mortgage market with rates going up and going down, all of those, and people not knowing where they are. They will want stability, because that's a vote winner, isn't it? It's what isn't a vote winner is every single month interest rates going up and people expecting what on earth. It's a very personal thing, isn't it, with when you have a mortgage and how many million people in the country have mortgages, because it affects them directly. And the rate increases that have happened over the last year or so, it's affected every single person who has a mortgage directly, or if it hasn't now, people you talk to know they're going to come into a big increase, and it's not something anybody is happy about. So definitely, the government will want stability. I think it's sort of come hand in hand with how the market is, how inflation is at the moment. Everything I think has stabilised quite a bit. It makes sense that rates are sort of evening out. They're dropping a little bit. Obviously, the rates are higher. There are bigger margins for the lenders at the moment. We know that. That's basic maths. But we are seeing rates drop a little bit. They are a little bit more competitive. But that doesn't necessarily then kick into the property market, because we're not seeing that sort of correlation.
Yeah. So I mean, let's move on to that then. So with mortgage sort of products and rates and things stabilizing, is that having a stabilizing effect on the property market and what people are actually doing in terms of transacting and things? Or, well, yeah, what are you seeing in the current property market, I think is what I'm trying to ask.
Overall, from the mortgage side of business, and it's always interesting to speak to agents who you know and you trust. I have my own opinions on that one, but I've got some good people who I know, and they are saying it's very, very quiet indeed. They're clinging on to any chains they have and any property sales they have going through at the moment. We're seeing quite a few within the business. If chains are falling over, it's quite often the first-time buyers. Now, no particular reason, because are you ever going to get? I mean, I'm sure you guys have gone through it, where a chain has fallen through for whatever reason. Do you really get the answer you actually believe at the end for it falling through? Everybody's skeptical, aren't they? But it's always seems to be at the moment the first-time buyers. Now, my opinion is, going back to that, is that if you're a first-time buyer, you were probably starting to look at the property a year, 18 months ago, or you had it in your mind, right, we're building up a deposit. Is mum and dad coming to come in and help out? Is your grandma, grandpa helping out? Whatever the case may be, there with a deposit. Do we have enough money? And at that point, they would have got an agreement in principle from someone like myself. We would have given them a quote. Here it is. This is how much it's going to cost you. And of course, that's going to be vastly different to what it is now. So if they've eventually found a property, which has been difficult because the property market, there's not a lot of properties around. And that's the simple truth. They're just nothing. No, there is nothing on the market, but very little on the market. So they're taking their first-time buyers are taking their time to find a property. They have, and then all of a sudden they're not paying. And I'm just throwing figures out there. They're not paying £1,000 a month for it. They're paying £1,500 a month or £1,600 a month. And and then there's a lot of media saying, "Well, are we expecting a property crash?" Now, if you're a first-time buyer and you've just had a huge increase in your mortgage payment, you're then hearing pretty much everywhere saying, "Oh, are we expecting a property crash?" Which I don't believe we're expecting a property crash at all. There's nothing indicating that whatsoever. But if you're a first-time buyer, you've never gone through that before, you've never had a mortgage, you've never had a property, you can see why you would get nervous. You could see why banker mum and dad are saying, well, actually, maybe you should leave it a year. Maybe you'll get it, maybe wait it out. See if it does come down, 10%, 20%. And of course, we know it's just monopoly money, and 10, 20% can go down one week and go up the next week. It's sort of fairly irrelevant. However, I think on a first-time buyer, it's very, very different. And that's from my experience with first-time buyers. I've spoken to agents. They're feeling exactly the same. And of course, on top of that, you're now in the world where people are going, and it's not necessarily a good thing, we haven't seen this for a while, where people are renegotiating price right on exchange, which is just horrendous. Well, there's two things which are, here we are, I'll jump on my soapbox, guys, for a moment. Two things which are really getting annoying me at the moment. If a really good property comes on the market, agents are going to sealed bids, which I just think is absolutely horrendous in itself. Whoever come up with this idea is just, the agent, wins on this one because they make more money from it. I'm not convinced the seller makes on this because they're not choosing who they want to buy the property. And I think in this market is a huge, huge thing. You do your due diligence on who's buying your property so you don't fall through. That's where the good agents are standing out in the market at the moment. They're doing a huge amount of background checks, and I'm seeing it all the time. An agent still they've sold the property and then they don't even bother calling me or having any contact with me. I think that's absolutely ridiculous. So you've got that, and then you've got on top of that, you've got people saying, right up on exchange, the market's fallen. I'd go and ask them for £10,000 off, £20,000 off. And of course, that then has a ripple effect all the way down the line, because they will guarantee someone in the chain has gone to their absolute maximum and they can't afford to take a hit on a property. So, that's trying to, it's always been there, but it's really prevalent in the marketplace at the moment.
What are you seeing sort of on the investor side? Is the investor market still very quiet, or are investors starting to think that there are bargains out there?
Not yet. I think that's the thing. I think the bargains will come. For all the doom and gloom I've just thrown out, I think the property market.
I'm not inviting you to my Christmas party, by the way.
I'm great fun. Believe me, I really am. Give me a Christmas cracker and that's it. I'm away.
It's got mortgage rates in the Christmas cracker. It comes out. Did you get the buy-to-let thing, or did you get the?
Oh, it's so much fun. Let's talk rates. Right. No, the mortgage the market going forward. I think certainly from talking to and we've had meetings about this. Portfolio landlords who have smaller properties who then know they're just not going to be financially viable moving forward. What's the point? If you have and when I'm talking about that, it's generally the one bedders where you can put a rent up by, you can put it up by 50 quid, you can put it up by £75 or something. You can't put that up 2 times, 3 times in line with your interest only mortgage, which is going to go that way. Whatever anybody says, that's where it's heading when you come off your fixed rate. Now, of course, that we haven't seen all of that yet because people are still sitting on 5-year fixed rates and they may not be expiring until 2024, 25, 26. So, but as that time passes, I think people will then just go, there's no point. I'm not putting in, hundreds of pounds a month on a property in the hope that the capital growth will help me out in years to come. Because the capital, as we know, the capital growth on a smaller property, it is not as big as then if you've got a nice 6-bed HMO somewhere, or hopefully. So I think the market will pick up. I think as a society, we like to move. People like to move house. We've had that for the last probably 20 or 30 years. I think the statistics are every sort of 4 or 5 years, people then tend to move if they have a family, on average, until they get their forever home, which is generally in their late 40s, 50s. So I think that, and if we haven't been moving, and clearly we haven't, you can see by the land registry figures and the stamp duty figures, more importantly from the government, that then becomes a knock on. Because the government are not getting stamp duty income. It's dropped massively, absolutely huge. I mean, staggering figures. Wish I had them here, but you can research and they're staggering. And if the government haven't got that income, well, they're going to want to do something. So again, personally, I expect they'll put in the stamp duty holidays or for first-time buyers again, or put that up, or they'll come up with something to try and get the property market going, which then I think then helps us all, because it certainly helps me and my business because the people are buying again and they want our advice, and it then helps you guys because there's more on the market, there more becomes available. Or if you want to offload, there's a better chance of offloading because there's more out there and there's more people looking. So I think it's positive in that sense. When that's going to come, when that's going to start changing, I don't know. But I'd like to think we're possibly going to have a slow end to the year, but then things will certainly start turning around beginning of 2024.
You heard it here first. Next year, property market is going to be moving a lot faster and heading on its way up, maybe.
Maybe.
So another topic we should really talk about is the fees, and we've talked about this before. Last time you were with us, Simon, and the fact that the headline rates that mortgage companies are advertising are going down, and they keep saying we've knocked 0.25% off our rate. Oh, and by the way, we're not going to tell you that we're now charging 2% more as a fee, and it's now up to 7% of a fee or something crazy. So what are the ludicrous fees up to? And yes, what's the going fee rate?
I've got a great one for you. I knew you'd pick this up from last time because it sort of shook you to the bone. Limited company buy to let. 300. I think I've done this on a £350,000 mortgage. The rate 5.19% for a buyer. I think that's quite good because that's cheaper than some of the residential rates with a £15,000 fee.
Oh.
That's really hits you where it is. So
it's fine if you're buying a £2 million property, though. I mean, that's a tiny fee.
Yeah, absolutely. Yeah, but it's not fixed. They're going up to 7% now. We're seeing a 7% fee, and it's just simply they haven't said it. Of course, they won't. The lenders won't say it because they can't. But the fees are so much higher because so you can fit the stress testing. And for people out there to know about stress testing, for a buy-to-let, the lender will work out the maximum you can borrow on the valuation of property and also the rental income you receive each month, and then we'll have put it through a calculator and tell you how much you can borrow based on the interest rates which are available at the time. Lower the interest rate, generally, the more you can borrow. So if they reduce the interest rates down, they can lend more and it attracts people in. However, the rates are a lot lower than they should and they priced in at, so they've got to make their money back somewhere. Of course they have. They're a bank. They've got shareholders and we need to bail them out every financial crash. So they have to put great big fees on. Are they attracting buyers in? Certainly not in our business at the moment. And I've got, I've been in the business 25 years, and I've got friends and brokers in some of the largest brokerages in the city. They're not doing any buy-to-let mortgages at the moment because the rental coverage just doesn't work.
And Simon, are they adding those fees to the loan predominantly? Everybody.
It's very, very rare that I ever come across. Can't even remember the last time someone has paid a fee up front. So yes, they're all adding it to the loan. I mean, as it is at the moment, you just why would you? I suppose.
No, absolutely. I'm just thinking, because obviously when you spread that out or amortise it, as I like to say, I mean that equates to, I just did a quick sum of, over 30 years, it's an extra £40 a month. So, that doesn't sound like it, but that's without interest, by the way. So obviously you're going to then pay the interest on that. So yep. It's staggering what the banks will be taking from us, certainly in terms of the fees. So I guess from fees, we jump then into sort of current rates and what you're seeing happening there, if anything much is changing.
Yeah, I mean, I go back a while from our chats previously in the year, and they are changing. They have changing. They are dropping slightly. Sort of to give you an example, for just a standard, I don't want to go through too many, but a standard mover or remortgage, 75% loan to value. So 25% deposit in, 2 years at the moment at 5.24, 5 year at 4.81. So it has dipped. They have dipped just below the 5% mark, which is good. That hasn't really, strange enough, I just looked back in figures in June, hasn't really changed very much. They were nigh on identical to June. In August, they went up slightly. And then you look at this at this time last year, very slightly higher than where we are at the moment. So it's quite interesting in that sense that the banks will publicise and market heavily. And we're talking, Stuart or Cameron, weren't we? About a LinkedIn marketing brief I put out about. But I think Barclays and Co-op at the moment are dropping rates by up to 0.4. And that looks fantastic, nearly half, just under 0.5%. But you don't see the rate increases in between time because they must have gone up for them to then put them down again. Because otherwise these rates, how come the rates are nigh on exactly the same as they were a year ago? Literally 13th of October last year, 2-year rates were 5.7. And I've just said today they're 5.24. So they're about 0.5% higher.
And that's what caught my eye off the LinkedIn post that you did, was because I had a quick look at the rates and it was for residential. So although I wasn't specifically interested, but it was interesting just to look at the loan to values, because I think I looked up to the 95% loan to value, and you'll correct me, but for example, it was something like 4.5% at 95%, and I thought, wow. Or it might have even been above 6. I can't remember on the way. But either way, my thought was, wow, if now you're getting a 95% loan to value as a homeowner, not as an investor, but as a homeowner, that is dramatically increased upon what it would have been 2-3 years ago. And that's what I was thinking. So exactly that. They're sort of headlining, look at us, we're dropping all our prices, but we are still way ahead of where we were a few years ago, and that may continue.
Yeah, absolutely. I mean, a 95, it's got to shoot to the other end of the spectrum and sort of at the 95% rates. and they are 2-year rates are 6.19 at the moment, whereas a year ago they were 6.39. Hardly any difference at all. But you're right. If you're then probably 6 months, I haven't got the figures here, but 6 months a year before that, 95% rates were probably still 2.5%, I would say, and that's at 95%. Maybe they maybe been slightly under 3, but the 75% rates would have been 1.1, 1.2. So that's a massive difference.
That's just such a different world, isn't it? I mean, it's just
crazy.
Wow.
Yeah, I mean, that's really different. And that sort of goes back a little bit as to what, you can see why first-time buyers, if 95% is mortgages are geared towards first-time buyers. Of course they are. We know that. So that's why first-time buyer thinking, well, I looked at this a couple of years ago and it was X amount. I was only going to be paying 2% or 3%. Now it's double that. It's absolutely crazy. But I still think, to be fair, it's less than 1% higher than the 75% LTV rates. So I think that way is not, it's not horrendous. The buy-to-let rates, as I said, limited company buy-to-let rates, where I was saying they're pretty much the same as HMOs. HMOs are about 0.3, 0.4 higher, same sort of fees. If you want something with a normal fee, and when I say a normal fee, people would then generally expect a 999 fee or a 1495 fee. The lenders love putting those fees out there. If you want something in that, you're looking at about 0.75 higher to make that work. But then, of course, it goes back to the good old stress testing, and the banks, unless you have a lot of equity in the product in the property, it's just not going to work. HMOs, as we know, a lot easier because the rental income is so much higher. So generally they will work. Standard buy-to-lets, difficult.
Yeah. So if we ignore the stress testing and we assume you can get a 75% loan to value kind of mortgage, what sort of rates are we looking at for personal name buy-to-lets?
Personal name buy-to-lets, 2-year and 5-year, 5.3.
And is that with crazy fees?
No, that's with standard fees.
Standard fees, okay.
Yeah, that's with standard fees. So yeah, certainly not horrendous.
And then buy-to-let in a limited company?
And buy-to-let in a limited company, you are looking around about the 6% mark.
And you said HMOs are about the same, or
HMOs are slightly higher. You're looking probably about 6.5%. I haven't got the exact figures here, but about 6.5% with a normal fee, as we would call a normal fee. So they're out there not doing, again, I have HMO clients and not particularly, they're looking to buy. But they're not on the market at the moment. They are, but not the ones you'd actually want to buy. A lot of work involved. They've been HMOs for years. I think some people have had HMOs for years, and the licensing is, catching up with them and what they have to do, and realise they actually have to do an awful lot more work than they first anticipated. So a few of those are on the market, but certainly not a lot. Are we going to see those come back on the market in the same way? I don't know. HMOs are always slightly different beast because of the income is generally so good. So there's tends to be as you guys would know, tends to be an outside reason for someone putting it back on the market. But I certainly think the buy-to-let, the standard buy-to-let, standard properties, I think we'll start to see more of those in the sort of between now this time, for the coming year, let's say.
And those rates you were talking about, are we just talking sort of average loan to values of around the 75% mark? Is that?
Yeah. I mean, there are rates out there. I did have a look at that before coming on and looked at 85% rates. There are 85% rates out there. They'd make your eyes water because they're up sort of 7.5%. But I had a quick look. I didn't spend too much time on it because it was fairly pointless. And you think, well, how on earth is that going to work? They're never going to meet the stress test in a million years. So I don't really know why the product is out there. It may fit on the rare occasion, but the the buy-to-let market, as we're seeing all over the sort of mortgage advisor forums. There's a couple of large forums which people go on, and if you look in between the trolling, you can actually see you can see people. The buy-to-let market is very, very quiet because you have to put so much in as a deposit. I'm looking at I'm talking so much. 40, 45%, 50% if you're looking in the southeastern London. Why? It's quite. Why would you put 50% of the property? I mean, in the southeast, the properties are so high in value anyway. So why would you put that much of your own cash in? At the moment, you would probably wait it out.
And that's why things are slowing down. And I know we're going to wrap up, but the final anecdotal piece from me is, I started investing in HMOs, let's say around 10 years ago. As you know, Simon G, I only looked at 85% loan to values, didn't look at anything else. Now I don't even consider it. I mean, I'm not actively looking to buy, but I don't even look past 75%, not because I don't think it could. I mean, I think it could work because the HMOs, as you say, if you're looking at minimum 5 beds and above, we could probably get the profit to work. But the contingency just is no longer there because of the price of everything else in terms of, energy costs and so on, insurances and whatnot. It's just, I worry. So I think I would have to have more equity in the property for me to feel comfortable doing what I used to do. And I just look back and think, wow, that just feels like a different world that we were working in then. So, for me, that really drives home how different things are, because I don't even look really past 75% for HMOs, whereas once I just thought that would be silly of me to put that much money into a property when I knew I could put it to work elsewhere.
I agree wholeheartedly, and we talked about it many, many times over the years, haven't we? About how much you put in, and it would have been mad for you at the time to put 25% deposit into a purchase. Why would you, when the rates were so low or so good at that time, or and looking at, like you say, the contingency? Well, we didn't know at that point, 10 years ago, 5 years ago, that the fuel prices were going to go up so much. That's made a massive difference to a lot of HMO owners. So and also interest rates. Interest rates have just jumped up. So and all of a sudden you think you've got a 10%, 15% contingency or some money in the background. That's gone. That's disappeared a long time ago, hasn't it? So you've just got to look at it a little bit more carefully at the moment. It will be there. It will come back. There is some positivity out there. You've just got to look really, really deep for it.
Right, and we'll finish up on that then. Keep looking really, really hard for that positivity. Yeah. It's there somewhere. So if you've got anything you'd really like us to discuss with Simon Glastonbury next time he joins us, please let us know. You can email us on show@thebusinessofproperty.com. And if you'd like to get in touch with Simon to ask him something direct, something specific about your own personal case, his contact details will be in the show notes. And Stuart and I will talk to you again next time.